So Brian, thank you so much for taking time out of your busy day and joining us. So this way we can bring some information about, the forbearance program to our viewers. Tell us a little bit about yourself. You're in the lending industry. How long have you been?
Sure. Well, thanks again for having me. So I run a family-owned mortgage brokerage here in Orlando. We've actually got a couple branches, one in Orlando and one down the Keys, and we service the entire state of Florida. I personally have been in the business for almost 5 years. I've been in the finance industry though for probably about, I'd say, going on 8 years, and just been dabbling on the mortgage side for about to be 5. And yeah, it's been between this year and last year, it's been a roller coaster of a ride, that's for sure.
Absolutely. Now, I know that we're getting ready to dive into forbearance, and we've got some great questions lined up for that. Yet, from your perspective, how do you see the real estate market right now from your vantage point?
Man, from my vantage point is what my realtors tell me. But I kind of see from what I've been told and what I'm seeing is we don't see the craziness, the influx of buyers going to the sellers like we did earlier this year and late of 2020 as well, where yeah, if you put a home on the market, you're still going to get some offers, but it's not the 10, 20 offers within 48 hours kind of deal. So I've heard that. I've also heard and seen that supply has gone up a tiny bit, which has kind of helped balance out the market a little bit. So, but that's kind of what I've been seeing. So I'm just going with what my realtors tell me and say, hey, this is what we see out there. They're the experts. You guys are the experts on that.
Absolutely. And yeah, clearly it's been a challenging market on our end, at least for buyers. That there's inventory, and yet when the inventory comes on the market and it's especially good, buyers just start to sort of outbid themselves in the process. So that's been the biggest challenge. And so regarding forbearance, there are people that are still out there kind of scratching their heads about what the whole forbearance program is about. So how could you best describe it?
Yeah, so forbearance in its simplest form is just a plan that your mortgage holder who's holding your loan is allowing you to put a pause on your mortgage payments. It doesn't mean that you are going delinquent. It's not going to affect your credit negatively. It is simply the loan holder saying, we recognize there is a hardship in your life and we are putting a pause on your mortgage payments so that you can get back on track. That's really it in its most general terms.
Absolutely. Now, with forbearance, you've got your repayment options once you go into the program, and then you're looking for an exit strategy. So what repayment options are available for borrowers, and how would they know which option is best for them?
Yeah, so there's 4 main repayment options, and everybody with a mortgage would have to speak specifically to their mortgage servicer. And when I say that, I mean wherever you're logging in to make that mortgage payment, that's who you need to speak to, because not all of these 4 options are going to be available to every person. But the 4 in general, one is reinstatement, which means if you were in forbearance for say 3 months and your mortgage payment was $1,000, so 3 months, you're behind $3,000. A reinstatement is you pay it all off at once, $3,000. Here you go. You're back on track. So that's option 1. Option 2 is a repayment plan, which is kind of exactly what it sounds like. If we keep going with that same scenario of a mortgage being $1,000 and you missed 3 of them, you might not have that $3,000 to just give. So what your servicer could do is say, all right, instead of $1,000, we're going to get you back on track and pay $1,200 a month. And that additional $200 will eat at that $3,000 that you owe. So that's option 2. And that one, truthfully, is a really common one. The third is payment deferral. So this is where you basically we'll keep using that same scenario, that $3,000, and you put it towards the end of the loan. So if your mortgage is, say, the whole mortgage balance is $100,000, We're going to take that 3,000 you owe, put it at the very end. And now if you were to pay it off, it's 103 instead of 100. And then option 4 is modification. This one is probably the most rare. This is where if you go to your servicer and say, hey, my hardship was not just due to COVID, this is a permanent hardship, maybe loss of job, loss of the breadwinner in the family, something that's serious and permanent, your loan servicer could do a modification where now instead of $1,000 a month, they drop it down to 500 or 600. And that is your new mortgage payment going forward. So those are the 4 main options. And I think you said to go on that of what's I think remind me of your question, like the best way to go about it or who to speak to, was that it?
Right, for the borrowers to be able to identify which option out of those 4 would be better for them.
Got it. So first, you've got to go directly to your servicer, who, again, whoever you are making your mortgage payment to, log in, find their email, find their phone number, call them. The second thing that you'll want to do is if you have a financial advisor or your financial advisor is your spouse, pretty much figure out what's your plan moving forward. Are you going to sell your home? Do you want to maybe refinance, or maybe neither, stick right there and maybe purchase something on the side? So you just need to figure out your plan. And then if after speaking to your financial advisor, whoever that may be, and you've already spoken to your loan servicer to figure out which option can do, third person you got to speak to is your loan officer or your mortgage consultant, because you already have a plan. You already know what options for forbearance are on the table. Now go talk to your loan officer and see how do we make that plan work? What is that next step?
Absolutely. So let me ask you this, Brian, for any of those 4 options, would a borrower need to qualify, whether it's for the repayment or the modification?
So the modification, yes. To my understanding, you're basically going to have to prove to your loan servicer and the loan holder that you have that permanent hardship. They're not just going to easily take your $1,000 a month and drop it down to 600 or whatever it may be. You've got to prove it. In regards to the repayment, that one is, from what I've been researching and seeing, that one is pretty easy to get. And again, it's pretty common across the board. Fannie Mae and Freddie Mac are big fans of that and promote that one quite a bit, where it is simply, again, just adding that little portion, throwing it in there. And it is showing them and showing your loan officer, okay, yeah, we're getting back on track. We didn't have that full 3,000 to give right now, but we can do the 1,200 a month instead of the 1,000.
Very good. So that does sound like it's the most popular one right now amongst.
Yeah.
Okay, very good. So then how does the repayment option vary by agency?
That's a great question. So Fannie Mae and Freddie Mac, luckily, they might as well be twins because a lot of their guidelines are the same. They're pretty much just saying that if you are in forbearance, not to get too into the weeds, if you are in forbearance, we need to find out which plan you're on. And then again, talk about whether you're trying to sell and buy or if you're trying to refinance. And they're basically saying the same thing. FHA, they are a little bit different. I don't want to get too into the weeds, but basically Fannie Mae and Freddie Mac want to see that if you turn the forbearance switch off, they want to see 3 months of payments, 3 months of mortgage payments to show, okay, Joe Schmo's back on track. FHA, on the other hand, for certain cases, this isn't across the board, but for certain cases, they want you to turn that switch off and have 12 months of payments. So they are a little bit more, quite a bit more conservative. So that's really the difference. And VA, for the most part, follows FHA as well. So you got Fannie and Freddie being a little bit more lenient, FHA and VA being government-sponsored entities. In that case, they're a little bit more strict.
Gotcha. Earlier, or a moment ago, you mentioned that it would be a good idea to speak with an advisor, someone that can help you prepare for forbearance, whether you're entering or exiting. So at which point do you believe would be necessary for a borrower to get in touch with a housing counselor or even talk to a lawyer?
I would say right after they've figured out what options are on the table for them. So fun fact, Fannie Mae and Freddie Mac both have free housing counselors that will speak to anybody that let me back up here. If your loan is being is owned by Freddie Mac or Fannie Mae, which there are websites to find that out. If they own them, they have free housing counselors you can speak to. So I would say after you've spoken to your servicer, you go and then speak to your housing counselor, whether it be one that they're offering or someone separate or an attorney if you'd like to. But that's really, I would say, once you find out what your options are, okay, now go talk to that counselor or an attorney.
Perfect. Okay, and then other than the repayment options, Brian, that we've already covered, what are other exit options that a borrower may consider?
If it's not any of those, I mean, even to refinance, you're going to have to show that you turn that forbearance switch off and got him back on track. Truthfully, the only other option you have is to sell it. And there is no gray area there. If you are in forbearance, you've got those 4 options and whatever your servicer is providing. If you don't want to get into forbearance, which it should not be, but if you feel that that's too scary of something to get into, then you can refinance. Ideally, I mean, rates are at still historic lows, so there's options to lower your payment that way. But if not that, you've got to sell the place. And that's another option. That's pretty much your last option.
Absolutely. And the real estate market right now, it's such a strong market for sellers that it would be to their advantage to consider that option versus how things sort of were back in 2008 and 2009, where people just got overwhelmed with their loan balances and they just walked away from the properties altogether. But in this market, if none of the repayment options are viable for a borrower, then it sounds like selling would be an option, especially with a lot of people being on unemployment, and unemployment income is not a qualifying criteria for a buyer to be able to refinance or modify or whatnot. Is that right?
That is correct. Does not matter how much unemployment income you are receiving. To the eyes of a lender, that will say zero. Because it's not income that you have technically earned. It's all about your earned income, and unemployment income does not count for that.
Absolutely. And so then how does being on forbearance, Brian, affect a borrower's ability to purchase again?
Well, that is the $1 million question we get asked almost every day. So if you are in forbearance and you have intentions of purchasing again, the forbearance basically needs to be gone one way or the other. So let's say that you own a property and that one's in forbearance and you want to buy a vacation home or an investment property. You just want to buy a second property. That first property that is currently in forbearance needs to be off, and you have to make at least 3 mortgage payments in a row for us to even consider. Before we even talk about how much you can purchase, it means nothing if we cannot see that you've turned the forbearance off and you've made those 3 mortgage payments on the current property. Now, slightly getting into the weeds here, let's say, we're in September 8th right now. It's not like you can go and make a September 8th payment today. You go tomorrow and make a September 9th, and then the following you make a September 10th. Now, it unfortunately doesn't work like that. We need to see you make a September payment, an October 1st, and then a November 1st.
Okay.
And only after that is when we can say, okay, Joe Schmo is pre-approved. So if they are trying to purchase that other property and their current one's under forbearance, turn it off, 3 payments in a row. Now, let's say it is their current home that's under forbearance and they are trying to sell it and purchase a new one. And again, let's say that, yeah, the forbearance is on. So they do have to sell that property. We need to see proof that that property has been sold and the mortgage has been paid off, including the forbearance. And at that point, you can close on the purchase. Now that doesn't mean that we have to wait for them to sell the home for us to pre-approve and go shopping. No, that's not what I mean. I mean, if you are trying to sell and buy, we can do it. You just cannot do it on the same day. You cannot sell your home and purchase a new one on the same day. Reason being, when you sell that home, it's probably going to take about 24 hours for us to see that forbearance loan has been paid off. And then after I can see that, I'm giving you guys the clear to close on that purchase. So realistically, it's probably, I'd say, a 3 to 5 day window, if that makes sense. So for anybody, again, considering that, you've got to think, okay, I'm not just going to be able to sell today and buy the same day. You've got to have a plan for where you're going to live for those 3 to 5 days in between. And correct me if I'm wrong, I think it's called a post-occupancy addendum that I've heard, where you can you tell whoever's buying your place, hey, I'd like to rent it from you for a week. Is that correct?
That's totally correct. You know, if you plan on continuing to occupy the property that you're selling, then having a conversation with a buyer about a post-occupancy agreement would be beneficial. Or if you are working with a seller who is okay with you pre-occupying their home before closing, then that would be considered a pre-occupancy agreement. So either way, they've got a couple of options there. Now, let me ask you, Brian, because you say we have to wait about 3 months for the forbearance switch to be turned off. Is this a requirement that your company has? Could it vary from lender to lender, or is this universal?
So in general, it is universal. And before I get into that, I also want to clear up that we can technically, if someone's really in a dire rush, we can technically pre-approve and get someone under contract to purchase a property, but they cannot close. We will not have that clear to close until we've seen those 3 mortgage payments made, right? So if someone doesn't want to wait until December to go shopping, they can go shopping, I'd say probably October, November-ish, knowing that, okay, I've made my September, I've made my October, and after my November, I'm good to close. So something to keep in mind. But to going back to your question, no, it is not something that we have. This is universal. This is directly from Fannie Mae and Freddie Mac. So there is no ifs, ands, buts about it. The only way around it is if a client is working with a lender that does not sell the loan to Fannie Mae and Freddie Mac. So if I were, if you're getting a loan directly from me and I am not giving it to Fannie or Freddie, I'm just going to hold on to it. I can make whatever rule I want. And there are some lenders that do that. Of course, the catch is you're not going to see rates in the 2s. You're going to see high interest rates. And that is kind of the big trade-off there.
Very good. Well, thank you for sharing that. And so, Brian, what additional insights can you provide regarding forbearance, or additional information that you think would be of enormous value to anyone who's either considering entering into the forbearance program or someone who's getting ready to exit?
My biggest thing, and this just comes from a personal level is just kind of have a plan. Like, think about, not right now. Of course, if you're in a hardship and it's like, okay, there's no breadwinner here, I cannot afford $1,000 a month for the amount of months into the future. Understood. So you are going to have to get into forbearance. But my biggest piece of advice is still consider the long term. Consider, where do you want to be 6 months from now, 12 months from now, 2 years from now? And loan officer, a mortgage consultant, can, in a sense, help you say, okay, you are going to go into forbearance. You need to, for reasons X, Y, and Z. But where do you want to be 12 months from now? Okay, this is the forbearance option you need to do. This is what you need to expect over these next 12 months. So that's probably my biggest advice, is just don't think that there's resources there. Use them. And I think that's the toughest part for some people. And I'm guilty of this as well too, where we just want to do all the research ourselves, and we want to feel that we know everything, and we don't need the assistance. We got Google. Google's got our back. And granted, Google definitely helps, but there are experts in this field that are here specifically to just fill in those blanks, to take more than just information, but create a plan and strategy with that information. So that's my biggest piece of advice, is outside of the short term, keep thinking long term, and talk to professionals to make that plan from the get-go.
Absolutely. And so let me see if we have some questions from any of our viewers. In any case, as we continue the conversation, Brian, after our meeting here today, if any questions do come through, we'll make sure that we get those questions answered for the viewers. We're so grateful that you took this time to meet with us and answer these questions. And we're also very grateful to be in partnership with you. Thank you for all you do for the community and in financing. And so, well, Brian, thank you, and you have a great evening.
Thank you. You as well. Have a good one.